All right, well, let's go ahead and kick this thing off here. Without further ado, we're going to go ahead and get started. Thank you guys so much for joining us today. I'm Jake Alexander. I am joined today by my fearless sidekick, Adam Taylor, and we're going to talk to you guys about some amazing topics. We're going to talk about BOI reporting and financial tips for navigating an election year in the financial markets. And so we're going to jump right into that here in just a second. Before we get started, I always like to do a little bit of housekeeping just to make sure everyone understands how to utilize the format that we're in here and gets the most value out of it as possible. And so we are in the webinar version of Zoom. I'm sure all of you are familiar using Zoom. If you've ever been on a Zoom call where 3 or 4 people start trying to talk or ask questions at the same time, you know it can quickly go off the rails and get pretty chaotic. So in respect of your time, we definitely don't want that to happen. We do these in the webinar fashion. And so what that means is down at the bottom, there's your chat box, just like there is in a regular Zoom meeting, but there's also a Q&A box right next to it. And so what we ask everyone to do is if you have questions throughout the event, pop them down there in the Q&A box. We have plenty of time built in at the end for Q&A, or if you do have a question that's relevant to the topic we're talking about, we may stop and answer it on the spot, just depending on what it is there. So how I like to start off, I say everyone find that Q&A box down there on the bottom, just type in your first name and what city you're from. A, so we make sure everybody knows how to use the Q&A box. But B, I always think it's cool to understand where everybody's joining us from and stuff like that too. So last time we did these, we had somebody from Hawaii join us. I thought that was pretty interesting. But so if you're with us already, go ahead and type it. Your name down there, just your first name and the city you're from. So Kevin from Tampa, thanks for joining us. We got Brad from Tampa. Our corporate office is located in Tampa, so that's where Adam and I are currently too. So usually that's where a lot of people be joining us from. Ron from Pasadena. Great to have you guys. And so we want to make sure everybody knows how to use the format down there. If questions come up, pop them in the Q&A box. We got plenty of time at the end to make sure we answer those. And we like to tell people too, when we do these events, we have people from sort of all different demographics joining us. Some of you guys may be clients currently. Some of you guys may be considering becoming clients, people we're working with already. And so we really just say that to say there's no such thing as a silly question. We want this to be a really great learning environment for everybody. So if there is something that comes to mind or something you do have a question on, type it in there. There's no such thing as a silly question when we're going through these. And so we'll kick things off here. I always like to give a brief agenda, just show you guys what we're going to be talking about throughout the course of the day. We'll do a quick introduction from me and Adam. This event is not necessarily about us, but I always think it's nice that we're not perfect strangers up here talking to you guys. So just quick backstory on us, who we are and why we're here talking to you guys today. We're going to cover BOI reporting, which is this new thing that came out. It's beneficial ownership information reporting, which is regulated by the Financial Crimes Enforcement Network. We're going to teach you how to stay in compliance and avoid nasty penalties, because there are some really crazy penalties for non-compliance in there. Then Adam's going to cover some financial tips over here. We're going to talk about specifically in an election year, things that you should expect, a little bit of things that happened in the past, currently where we are in the present, and then most importantly, moving into the future. And then we always build time for Q&A at the end. So we got plenty of time blocked off there. Like I was telling you guys, type in your questions in the Q&A box as they come up, and we'll make sure we get all those answered before the end of the event. So just quick introduction to me. I'm Jake Alexander. Action Accounting is the name of our business. We have 3 main departments. We have our bookkeeping department, tax preparation department, and our tax planning department. In bookkeeping, they're responsible for creating financial statements for our business owner clients to ensure that they're in compliance from just an overall bookkeeping and accounting standpoint, but most importantly, so they can get financial statements on a regular basis to understand how much money's coming into their business, how much money's going out of their business, and they can use those financial statements to make important decisions moving forward. In tax preparation, we help keep our clients in compliance by filing whatever tax returns are necessary for them from the business standpoint and the individual standpoint. And then most importantly, last but not least, I always say the tax planning department is where we proactively work with clients to put strategies in place to help them save as much money on taxes as possible. And so if you ever need to reach out to us, you can do so on our website. This right here is actionaccountingusa.com. And we're on all the major social media outlets there too. You can always find us. And so that's a little bit about me. I want to turn over to Adam, let him introduce himself real quick.
Man, that's a big photo. That's like, is that because I have such a big head that you put up the
It
big
could
photo?
it could just be the perspective there. So I don't know if it's really that big or if it's just a change of perspective.
Oh, goodness. Well, so I'm Adam Taylor. I'm sure I know a lot of you on the call, but I am the CEO and the founder of Taylor Financial. I'm a dork, so I take a bunch of tests. So I have a bunch of letters behind my name and always trying to sharpen the saw for our clients. So I'm pretty fun at parties. I'll talk wine because I'm a cork dork due to the sommelier background. Was that in restaurants before I joined financial services in 2011. Went independent with 28 and with Taylor Financial in 2018. I'm a Florida State alumni, so we won some pretty cool business awards, and then we've had some really good success here locally. So recently, we've been very fortunate to be featured in some really unique publications and news channels. So yeah, just happy to be here. So thanks for the invite too, Jake.
Yeah, it's awesome. Thank you so much for joining us. We look forward to hearing from you a little bit later in the presentation here. So all right, jumping in. So the BOI top 5 hit list, what we're going to cover today. We're going to talk about what is BOI, right? What does it even stand for? It's beneficial ownership information. We are going to jump into who has to report it. And so keep in mind, this is a new thing here. This is a new regulation. So who has to report it? These are called reporting companies. We're going to dive into a little bit of the people that this actually affects here and who has to do it. In any typical governmental fashion, there are the rules on who has to do it, but there's also 23 exemptions from people who don't have to do it too. So we're going to talk about those. If you fall into one of those categories, and that would be a good thing because it's something you don't have to necessarily worry about. Talk about how to report it. Everything is done electronically through FinCEN's website, which FinCEN is a financial crime enforcement network's website. And then we're going to talk about when you have to do it. So these are the main 5 topics we're going to go through here. When you have to do it. And I think that's where a lot of the I don't want to say confusion, but a lot of the questions come in is like, when do we actually have to do this? How often do we have to do it? We're going to cover all of that too. So quite a bit of information we're going to dive into. The biggest question we get from clients is like, hey, I've never heard of this. What if I don't do it? Right. And so the answer there is there's penalties. There's very stiff, large penalties that can be imposed for not doing it. And so there's civil penalties of $591 a day until corrected. And that was actually, when it first came out, that was $500 a day. They recently raised it to $591 a day. And then also criminal penalties of up to $10,000 and or 2 years in prison. So from my experience in this industry, the government puts large penalties on things that they take serious. So that would be my way to let everyone know. In this, we're saying it as loud as we can, screaming it from the treetops. This is something that they are taking very serious. It has to be done. So if you qualify as a reporting company and you need to report it, you want to make sure you get it done, and you want to make sure you get it done the right way because you don't want to end up with any penalties there. All right. And so what is BOI? BOI stands for Beneficial Ownership Information. It's essentially the information for the owners of companies. And so in 2021, Congress enacted the Bipartisan Corporate Transparency Act to curb illicit finance. And so this was specifically in line to offset crazy amounts of fraud, money laundering, illicit finance practices, and things that would be going on. And so this law requires many of the companies doing business in the United States to report information about ultimately who owns them or controls them. And so it's effective January 1st, 2024. Many companies in the United States must report information about their beneficial owners. So it's essentially personal information about the people who own the businesses. And so if you own a business or multiple businesses in different states, you're probably already familiar with this at a state level. It's every year you have to file an annual report that asks for updated contact information, personal information on the people that own the business. This is now essentially the same thing, but at a federal level. And so it's reporting the information for people who ultimately control the company or own the company. And so it is reported to the Financial Crimes Enforcement Network, which is a bureau of the United States Department of the Treasury. Who has to report it? And so Companies required to report are called reporting companies. So they basically will have to provide information about the owners of who owns it. And so this is specific if you are the owner of a corporation, an LLC, or a organization that was otherwise created in the United States by following a document with the Secretary of State. So that would be along the lines of like a sole proprietorship, possibly a partnership. This is where things get a little bit gray, but specifically if you're a corporation or an LLC and you file the document with the Secretary of State in any state, anywhere in the United States, you're going to have to do this unless you qualify for an exemption, which we'll talk about here in just a second. So also foreign companies registered to do business in the United States, they also qualify as well. And so essentially, if you're a corporation or an LLC, I would have this as something on your radar that you need to report for all of your entities that you have. And so, as I said earlier, in typical governmental fashion, there's always the rules, then there's the exceptions to the rules. And so for here, there's 23 exemptions. Like I was saying a second ago, if you're a corporation or an LLC, this is something you need to have on your radar that you need to get done, unless you qualify for one of these 23 exemptions that are there. And so if you're a securities reporting issuer, if you're a governmental authority, bank or credit union, depository institution holding company, money services business, broker or dealer in securities, securities exchange or clearing agency, investment company or investment advisor, venture capital fund advisor, insurance company. And as we're just going through these exemptions here too, you want to keep in mind if you own multiple businesses and those businesses do different things, which is typically the case, this could apply to some and not other, just based on exactly what your portfolio is made up of. And so state licensed insurance producers, the Commodity Exchange Act, a Commodity Exchange Act registered entity, accounting firms. So this would mean here, us at Action Accounting, we're actually exempt from having to file these reports. A public utility, financial market utility, pooled investment vehicle, tax exempt entity. So this is where it gets a little bit interesting. So if you're a tax exempt entity, if you're a designated nonprofit, essentially exempt from having to do this. If you're an entity assisting a tax exempt entity, so if you either are a nonprofit or an organization that specifically assists nonprofits, you may not have to report. Large operating company, subsidiary of certain exempt entities. So once again, some gray area there, right? And then an inactive entity. So if you had a business that was active, is no longer active, there's not going to be any requirement to report it there too. And so this is where, so you can see with some of this stuff, there is some gray area here. We always get the question of, what if I think I qualify for one of these exemptions, but I'm not sure? Our typical rule of thumb is going to be, let's go ahead and report proactively. There's not going to be anything hurt or anything bad caused by doing that. Where on the converse, if we don't report and we don't qualify for one of the exemptions, penalties, all that kind of stuff could be not such a good time on the back end. And so there's a little bit about the exemptions right there. From there we go, how do I report? So how do you actually do this? Everything is done on the FinCEN website, which I'm actually gonna type this into the chat there. So if you guys do want to go to the website, by all means, more than welcome. You'll see Financial Crimes Enforcement Network logo comes up in big pictures there. In big font there. It's nice and attempting to be intimidating. It's also, once you click to electronically submit the report, there's of course the waiver that says, check the box here to ensure you're not submitting any sort of false information under penalty of perjury by law. Once again, just letting you guys know this is something that's being taken very seriously by the government and by FinCEN. And so you want to make sure all of the information is accurate that you put in there. This is something you can do yourself, or you can always hire a professional to help with you. And so in our case, at Action Accounting, we're offering this service to our clients for $199. We'll literally walk you through the entire process, make sure everything is done 100% accurately. You are in compliance. If you qualify for one of the exemptions, we would go through that for you and make sure you don't have to do it. In my opinion, this is something you don't want to get wrong, just with the level of importance and the level of scrutiny that they're placing on it right now. And there's so much gray area because it is a newer thing too. So we would love to help you guys out if you do need help with it. By all means, if it's something you'd like to navigate on your own, the website I just put down in the chat right there as well. So from there, we go, when do I report? So this is something we get a lot of questions on right here. Like, when do we actually have to do this? Do I have to do it every year? And so they begin accepting applications as of January 1st of this year. So for whenever your entity was created, you could have been submitting these since January 1st of this year. It's where it gets a little interesting. So if you created or registered an entity, a corporation or an LLC prior to January 1st, 2024, then you actually have to the end of the year to do it. So if your entity's been around, has been in existence prior to this year, you essentially have to the end of this year to get your report done. So do it on your own or hire someone like us to help you out with it. If you created or registered in 2024, then you must report BOI 90 days from the company's creation date. So what this means is you created a new company in January, February, or March of this year, and you didn't know about this, you're technically already behind. So if that's the case, we can help you navigate those waters and get everything cleaned up. Or as always, you can self-serve. You can always take care of this on your own, but you want to make sure those dates are adhered to as much as possible to avoid penalties. And then any entity created or registered after January 1st of next year, you'll have 30 days from the creation date to submit BOI, which is your beneficial ownership information. This is a one-time thing. It's not something you have to do every year unless there are changes to the ownership structure of your entity. Then you'll need to update or correct information on the report, which is all done through a company like us that can help you, or on the FinCEN website there. And so that's a majority of what we're going to cover on BOI here. I'm going to turn it over to Adam, and he's going to talk to us about some of the navigating the financial markets during an election year. So I'll hand it over to you, Adam.
Cool. Thanks, Jake.
Yeah.
Yes. Number one question we get from our clients is, hey, what's going on in the interesting times we live in? How does that affect my portfolio now? And how does it affect it 10, 20, 30 years down the road, right? So there's a lot of great data out there. We try to avoid any of the drama, the headlines that could potentially change your investment philosophy and look at more of just data. We know the market is cyclical. It goes up, down, sideways, circle, and it's really, what does it look like long term? So let's go back 100 years and really think, how does the market do during presidential election years? I think you got the slide. There you go. So this was interesting. Jake and I went over this earlier, and he kind of had this puzzled look on his face. And I said, hey, let's look at the S&P 500 and what it's done going back to 1949. Had you invested $10,000 one time in 1949, and from a compound interest standpoint, as you can see in that graph, that one $10,000 contribution would be worth over $3 million right now. So the S&P 500 over the last 100 years has averaged a little bit less than 10% growth per year. So what has happened in the market the last 6 years? Well, the last 6 years have been on fire. And if you look at some of the underlighted, highlighted areas, if we look at from July of 2018 to June of 2024, so just last month, the S&P 500 has gone up more than 100%. And that's including in 2022 when we saw the S&P 500 go down 18%. So usually it's not this sunshine and rainbows, but it's been a really good run so far. So there's always a time to sell. We get questions and calls and emails from our clients saying, hey, with everything going on, should we sell? Should we reposition? And depending on when they want to pull money, potentially, maybe. But if we look at more of even a buy and hold strategy, if you have some time left, you can really still have some great growth. So if you look from 2007 to even just more recently, going from left to right, in 2018, we saw the market drop 19% right before COVID. And then as COVID hit, the world freaked out, kind of as they should. It was a epidemic. It was a big deal.
It was a crazy time right then.
Crazy time, right? And the market dropped 33%. And there's a lot of people who didn't heed our advice and they went to cash. or they just decided not even to get back into the market once they went to cash. And had you done that, as you can see on the screen, you would have missed a huge opportunity. Well, 4 years ago, we're kind of in the same situation we are today with election fears and the uncertainty of what's to come, but we still had growth in the market. Once rates started hitting, and then we had inflation, I think that was September of 2021 when inflation hit 9%, which is unheard of. Historically, it's been about 3%. We saw a little bit of drop there, right? And if you see that down curve, that's 2022, negative 18% S&P 500, not the best year. And it was the worst start of a year since 1970. But after that, 2023 was up 24%, and over a 7-year period, the S&P 500 was up 121%. So the takeaway there is that there's always going to be a reason to sell. And we can go back to the 70s, we can go back to the 40s, even the 20s of the Great Depression, wars, all that. But if you go back to that first slide where that 10,000 turned into 3+ million, you can see that long-term we have some significant compound growth. Okay, let's talk about year-to-date performance. Today is a red day. Today really actually sucks. With a lot of earnings came out on the tech side. Tesla's down 11%. They missed their earnings by almost 17%, and so there's a lot of red, especially on the tech side. But again, Tesla's been up 20+% the last month. So year to date, from January to obviously today, the 24th, the S&P 500 has been up 15% in less than 7-8 months. And then the Dow has been up 6%. And then the Dow is 30 more industrial, 30 companies versus 500 of the S&P 500, 500 large capitalized company. And a NASDAQ, if you think of that as an indice, that's more of the tech heavy, what's going on in the Microsoft, NVIDIA, like all the ones you probably see on the news all the time. Well, that's up 17% year to date, and that's taken into consideration the 3% drop we're seeing today. So here was an interesting survey from Investopedia. And this was the end of last year, but it's relevant today. And they said, what's the one thing that you fear or that could potentially affect your overall portfolio? And the number one answer was the 2024 election, and that was above a recession, that was above inflation. Now, since then, we started to see more soft landing, more of we're not going into any of those. But again, the number one concern coming into 2024 were the elections. So let's talk more about that. Okay, so a lot of data here. I'm going to kind of just dissect it here and there. And I think everyone will get a copy of these slides at some point too, Jake, right?
Yep, we send this out to everyone who attended and then also everyone who registered but was unable to attend by any means. So, and also
Cool.
too, not to interrupt you, but if you're just joining us or just joined in, make sure you utilize that Q&A box for any questions that you guys have, for anything that pops up along the way. We've got plenty of time built in at the back end to make sure we answer all those questions too. So,
yeah, good point. Okay, so let's go back 100 years, 1928. So there's been 23 election years since 1928, and you can see the average return of the S&P 500, which we knew was about 10% last 100 years. But if a Republican was elected, a little over 15% for that election year, and if a Democrat was elected, a little over 7%. But on average, over 11%, which is better than a non-election year. So in an election year, a Republican on average has a higher return, but I'll show you an interesting fact of what happens a year after between the two parties. But of the 23 election years, 19 of those have been positive, or 83%. When a Democrat was in office and a new Democrat was elected, the total return for the year was 11%. When we had a change in party from Democrat to Republican, almost 13%. Still, great numbers and above the average of what we've seen. And if we look at the far right-hand screen, we can see from the parties in different colors, but also the rates of return from those years. And take note of some of the poor years. So in 2008, when Obama got elected, the market went down 37%. But I want you to look to see what happened in 2009. I want you to see what happened in 2013 or 2017. So the year after the president was elected in that year. But just, and again, I know you'll get copies of these slides, and this is interesting to me. Again, I'm a dork. This may just be, okay, just tell me what time it is, not how the watch works, Adam. But this is interesting because, again, we avoid the drama, the headlines, we avoid all the noise that you may hear on whatever news channel you decide to watch. Okay, let's go to the next slide. Okay, so the S&P 500 returns the first year of a 4-year presidential term. So this would be, and again, that 2009, that would be 2013, 2025. So the first full year. You can see the average rate of return for a president that was on the Democrat side was over 20% in that next full year. Republican over 12%. So takeaway there is, statistically, the election year is a really good year for market growth. And as we've seen, plus 15% year to date, and we're obviously not even near the end of the year. And then the next following year is pretty good. So it's interesting to see that 2008, when Obama had a negative 37% downside, we had a really good rebound in 2029, and the market went up 26+%. So I thought this was interesting, again, because it's cyclical, it's data, and we just avoid some of the headlines. Next slide. Okay, so what does all this mean? I've reiterated this a couple times, so if you hit that right arrow, Jake, ignore the headlines, right? So next little arrow, work with a team. If you don't have an advisor, if you don't have a team, use them as a sounding board. A lot of the alpha we bring to our clients is that behavioral finance, behavioral coaching. They say, hey, let's not sell, even if the market went down 31%. Maybe we reposition, maybe we do some tweaks here and there, but here's what history has told us, right? When do we need the money? How can we do that? We use a lot of rule of thumbs, and if you're a client on the call, you've probably heard us reiterate this numerous times, but it's the 20-60-20 rule. And what that tells us is that we want our clients to save 20% first and foremost. If you can save first and then spend later, so much easier than to spend and then save, right? So we end up taking a lot of money from our clients just on a regular basis, whether it's monthly, quarterly, annually, but just forcing them to save, to not only be that accountability partner, but to help them get closer to what their goals may be. So that's the 20. The 60 is, that should be your fixed cost. So things that are not wants, things that are housing or vehicle or things that you can't really control to a degree, 60% of your income should be allocated for fixed cost. And then the other 20% should be for more wants and desires and going out to dinner, shopping, vacations, whatever. But save first, allocate 60% of your total income into fixed costs and then 20% into discretionary. So there we go. We talked about that. And so a lot of our clients, they're very fortunate. They make a good amount of money. So if you're making over $500,000, you can probably save more than 20%, right? And that's what we're going to encourage them to do, because in retirement, they want to typically live off of a higher dollar amount. Social Security may help a little bit, but not as much if your goal is to live off of $20, $30, $40, $50,000 a month. So getting them to save more than that 20% is crucial. Again, we talked about accountability. Building that muscle of just saving on a regular basis is very, very helpful. This is where Jake and individuals from the accounting side can help, especially if you're a business owner. There's so many cool techniques you can do. So leverage all the tax codes you can do, or all that you can. There's mega Roths out there, which are pretty unique. Roth conversions. We love any tax-free assets we can get. There's two really good books out there too. There's one called The Power of Zero and Tax-Free Retirement that talk about the impact that having tax-free assets in your distribution years can have. It helps reduce Social Security, helps reduce potentially Medicare or supplement plans. It helps reduce a lot of taxable events in the future. If you're a business owner, you're making really good change and you want to deduct more than $69,000 or $76,000 a year from some type of defined contribution plan, you can do what is called a DB plan, defined benefit plan, almost like a pension, and you can deduct hundreds of thousands of dollars to help reduce some of your top line income. Risk management. So whenever we talk to our clients, we do have let's see, I'm mirrored here. We do have an in-house estate attorney, Chase, who is not here today. His lights are off. Jake, by the way, is over here. But Chase helps with some of the foundational planning as well. He helps with estate planning when it comes to wills, trust, living will, durable power of attorney, healthcare proxy. We encourage all clients to get that in some capacity, whether they do it online or if they engage with someone like Chase. On the other foundational side, we want our clients to have a tremendous amount, or the appropriate amount, I should say, of life insurance. Most people are underinsured, and our rule of thumb is you need 10 times your annual income in life insurance, because most people want to pay off their debt, leave an income stream to loved ones, and then help take care of maybe any education for their kiddos. And term insurance is super inexpensive. There's $1 million plan for a healthy 45-year-old. I'm not 45 yet, but I'm getting there. And it's
We're close.
100 bucks a month, right? So it's inexpensive in our opinion. Get as much disability insurance as you can, especially if you're a business owner on the call and you don't have benefits through your employer. One of your most, if not the most important asset you have is to earn income. And if you can't do that due to some type of illness or sickness, you want to have that protected, right? So protect that golden goose, that income producing individual that you are. Shop your property and casualty insurance. My home insurance went from like $2,600 a year to like $12,000 a year. And I literally passed out, I think. And so I went to go shop around, and I found, thank goodness, something that was around $6,000 a year. It's still astronomical increase, but shop that every year, not only homeowner insurance, but look at your car insurance. Make sure you have, in our recommendation, 100, 300 coverage, so you can get things like umbrella coverages. And even the next bullet point, our umbrella coverage and liability is cheap. I think per $1 million, it's $300, $400 a year to have some type of additional protection in your household. So with all that being said, again, the main takeaways are: ignore the headlines. Election years are statistically a really good year. And even going into 2025, statistically, now again, there's a lot of variables, especially recently, it should be a good year from a market standpoint. And we've seen that fantastic growth even in the first 7 months of 2024. That's it. That's all I got.
That was great. And so thank you so much, Adam. In conclusion here, you need a plan. You want to be proactive about this stuff, which obviously you guys are, because you joined us here today and took some time throughout your day. So we would encourage you, when it comes to any of this stuff, don't delay into the last minute. If you do need assistance, we'd love to spend some one-on-one time with you. You can book a call with one of our expert advisors. I'm going to post Adam's calendar link in the chat there, and then the link to our website where you can book an appointment with one of us too. And at this point, that's all the information we had to cover with you guys. Adam and I could sit here and talk for probably a couple hours if we needed to, but we want to know if you guys have any questions. If you do, put them in there in the Q&A, and we'll spend the rest of the time to make sure we answer those for you. So Adam, that was some great information. I want to say thank you. It's been an honor working so close to you and learning more and more about what you guys do in your world. And it just, the synergies are so great, how we're able to work with clients. So I'm really enjoying that.
I echo that statement. So yeah, it's been great.
So I'm going to post the link here to Adam's website. Am I putting adamtaylor.com in there, Adam?
Yeah, that works.
So this will take you directly to Adam's website if you want to book some time specifically to talk with him. I'm going to put a link to our website in there too, which right on the front page, there is a button that says book an appointment. So if you need to book an appointment with any of us for any reason in particular, you can do that too. At this point, I'd encourage you guys, use that Q&A box, type if you have any questions in there, and we'll answer those. I always say if people don't have any questions, it's because we covered everything so perfectly and succinctly that there couldn't possibly be any questions left after that. And so I put in there in the chat, I put the FinCEN website, I put the website to book time specifically with Adam and his team, and then with us over here at Action Accounting as well. And so Brad, great session. Thank you so much. Appreciate the feedback. Let us know. I put the links to the websites in there. We look forward to spending some time with you. I wanted to say real quick, Adam, you briefly mentioned Social Security. I don't know if anyone else caught it, but the last debate there, Joe Biden said one of his instant, if he was reelected, which obviously is not going to happen now, but one of his instant changes would be to raise the Social Security limit to over 400,000 per year, which right now it's 160,000 per year. People are paying 6%. If you're a business owner, almost 15% on that income. For that to get raised to 400,000, that would cost a lot of taxpayers, a lot of high wage earning taxpayers, a lot of money right off the bat there. So interesting, you know?
Yeah, I know it's funny. So that's a big hot topic right now, not just from the political standpoint, but of like Social Security and funding and what happens in less than 10 years when Social Security may not be sufficient to be able to pay all the benefits that are out. And if we continue to do what we're doing now, from, as you mentioned, the wage and all the limits and all the entitlement benefits that we have, yeah, Social Security could run out, and benefits could be reduced by 35%. So ABC Action News actually interviewed me about a month ago, and if you look at either Adam Taylor, ABC Action News, or Taylor Financial, Social Security, there's a longer video there. It goes
Oh,
through
great.
what we would recommend of how to change that. So it's a really big hot topic right now, because less than a decade away, some really strong entitlement benefits could be reduced quite a bit.
Yeah, and that's a major impact for people of our age bracket, I would say, right? I mean, no matter which one you're in, but especially I'd say in our age bracket, is that something we could even reasonably count on being around at all, in your opinion?
Yeah, good question. So, Jake, you're what, 40 now? I forget.
I'm 40, yeah. I'm so much younger than you, so you couldn't tell by the way I look, but
Listen, my hair is retracting, and we're trying to run away as quickly as possible. So I'm 42, right? So in my personal plan, I do not put the Social Security estimate at 100%. Because
okay.
if I want to be done, and my plan is to be done at 55, 60, now granted, that's 10 plus years out. But when I would turn Social Security on would be earliest 62, more likely 67, 70, and probably even later than that, potentially due to the increase. But when I build my plan, I'm building my Social Security benefits, projected benefits, at 70%. I
Mm,
just don't want to, I don't want to overestimate something that, as you mentioned, may not be there or will change. And I think Social Security reform has to change. It hasn't changed since the Reagan era of early 80s. The RMDs, required minimum distribution, have been pushed out to age 73. Yet full retirement hasn't been pushed out for a long time. People are living longer nowadays. Our financial plans, the age goes out to 95 for a lot of clients. If I make it to 55, I'm be excited, but
yeah.
95, it's just wild to me. And so having multiple decades of income in retirement is a lot, right? But I do think that one of the easy easy tools to change the Social Security and how to help with the bucket of money that we have is to push out retirement. You know, right now, if you're born after the year of 1960, your full retirement age is 67. But if you wait each year, you get an 8% raise up to 70. But I do think they're going to push that out some, as well as some other strategies to help kind of replenish the bucket for benefits.
Yeah, it's a real interesting topic. For the time I've been in the industry, I've been in the tax business since 2014, maybe 15. The Social Security limit was just over 100,000 back then. I think it was like 112, maybe 109, maybe when I first started. And now to see it at 160 to me, because just in the past couple years, it's made this significant jump from 119, 127, whatever it was, to here him throw out 400,000, like to make a significant jump like that. It says they've got eyes on it, like they know something needs to change, you know?
Yeah. Yeah. I mean, Medicare tax has been unlimited for as long as I can remember. So having a limit on Social Security, yes, but increasing it, I think that's something that absolutely will happen. Going from 160 to 400, that's an extreme in my opinion. But
That's a big jump. Yeah.
yeah.
Well, so guys, thank you so much for spending some time with us. If you got questions, put them down in the Q&A. If you don't, like I said, me and Adam take that as a compliment because we covered everything so thoroughly and so energetically, enthusiastically that you couldn't possibly have any questions. We've got our links to our website down in there, links to the FinCEN website. Go out there, file your BOI reports, schedule a meeting with Adam and his team to discuss your financial strategy, schedule a meeting with us and our team to discuss your tax strategy. If you guys have any questions, pop them in there. We'd love to answer them. If not, we'll hang out for a couple more minutes and then we'll let you guys all go on about your day. So Kevin asks, if you pay us to do your BOA, how long does it take? It's pretty quick. Kevin, we could have a turnaround within 30 days tops for you. I'd say it all depends. We have a questionnaire that we have you fill out. So the faster you get us that questionnaire back, the faster we can get everything submitted for you. So once we get that back, it shouldn't be longer than a week for us to get everything completed. The whole process can be done within 30 days though.
Jake, I know this is somewhat a little off topic here, but like, I didn't really even have this on my radar until, a few clients brought it up less than a month ago, right? So
Yeah.
how many other business owners are in the same boat who aren't going to webinars like this? Or like, I just feel like no one really knows about this new thing. And are they really going to penalize and charge all this money to business owners who are just trying to grow the business, spend time with their family and earn an income? And like, it baffles me that this is not talked about more.
No, yeah. So to answer your question, a lot of people are not aware of it and kind of have this same reaction too. It's why we decided to do this webinar here. The first mention we heard of it was right around March or April. So anybody who knows anything about our business, that's like our craziest time. So of course, any sort of new information that comes out in the peak of tax season, our typical response is like, we'll deal with that in May or in the summer when things calm down. And the legislation's been there for quite some time, but them actually enforcing it just started as of this year. And so a lot of people are not aware of it. A lot of people started getting those emails right around the same time. And, there's all kinds of different spam/scam alerts and everything going on. So a lot of our clients thought it was just something of that nature. Like, hey, is this even real? Is this something that we have to take care of? And so the answer is yes. Going forward, we're going to make as much of an effort to, make aware our clients to make sure they get it done, make sure they get the reporting, everything, and minimize those penalties. What I can say about the one that I think will cause the most issues is people who created new entities this year and didn't know they had 90 days to do it. And so with that, no guarantees, obviously, but with working with the Internal Revenue Service as much as we do, if it's the first time and there's penalties, they're usually pretty good about making an exception there. Kind of like those 23 exceptions I was going through earlier. So if it's the first time, they're usually pretty good at working with us on penalties. I can't guarantee, but I would assume it's the same thing in this boat, where if it's the first time, we may be able to get those waived for you. But going forward, I think it's just going to toughen up on the compliance. And then going into next year, it's if you create a new entity, you've only got 30 days to go and then submit this new report too. So it's a new thing, kind of hit everybody like a ton of bricks and came out of nowhere. We're doing our best just to spread the word as much as possible. So. But all right. If you guys have any other last minute questions, pop them in there. If not, Adam, we can hang out for another minute or two, or we can call it. I want to thank you guys so much for spending some time with us. The recording of this does get sent out to everybody who registered. So if you joined us live, thank you so much. If you registered but weren't able to make it, you'll get a recording of it too. Kind of to Adam's point, if you know anybody who else is in the same boat who didn't know about this and needs to report their BOI, we'd love to have a conversation with them and help them out with it. So feel free to forward those to anybody you think may get value out of it, or a person who's a business owner needs help with their financial plans as well. And so if there's no more questions, I'll go ahead and we'll call it here. Adam, thank you so much for your time. Thank you all so much for joining us. We appreciate you guys. We'll talk to you all soon.
See ya.
All right. See ya.